Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Spotify continues to be on a nice run. The stock has almost doubled in 2023, and there's a lot of momentum behind the company for a number of reasons. But there are three main reasons I think this stock can continue to move higher this year and over the next decade. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content and check out the link in the show notes for my newsletter called Asymmetric Investing. I will also include a deep dive that I did on Spotify, so check that out. The first thing I want to highlight from Spotify's potential profit growth standpoint is the fact that the company seems to be focusing much more on the bottom line, on containing operating costs specifically, so that any growth in revenue can actually hit the bottom line and the company can actually see some operating leverage. Operating leverage is when profits grow faster than revenue because your operating costs don't grow as quickly as revenue grows. Spotify has not done that. They've been operating closer to break even, slight free cash flow positive. But I think we may be at a turning point where management is finally starting to focus on the bottom line. There have been a couple of rounds of layoffs over the last 6 months or year. And a lot of those really had to do with making the company more efficient. All of the podcast business has actually been consolidated under the Spotify brand. If you remember a few years back, the company bought a bunch of companies like Anchor, Gimlet. Those are going to be now under Spotify, a little bit smaller cost structure there to operate those businesses. And Spotify is really focusing on being the discovery channel in the podcast business. So containing those operating costs is something that we haven't seen yet in the financials. But if we do see that throughout the year, I think that's going to be another boost to the stock. It tells investors that there's actually an opportunity to increase margins in the future. The next two things I want to highlight come down to the company's growth. And I'm going to go to the latest earnings release. This is the high-level numbers that Spotify gives us every quarter. The number that really jumps out to me here is this 515 million number. This is the number of total monthly active users, including free and premium. But you can see that was up 26 million in just one quarter. Now, premium subscribers only increased 5 million, but those free users are really the top of the funnel for Spotify. They're the people who maybe just downloaded the app for the first time, just set up an account. They will eventually likely increase their usage over time and also potentially become premium subscribers. And that's really where Spotify starts to make its money. One of the reasons I think this user-based growth is so impressive is because, remember, we're coming out of the pandemic. We're going away from a time when people were at home, maybe had more time to listen to music or podcasts. We're going back to more regular life. And if people are increasing their usage of Spotify as they go back to the office and start to do more normal things, I think that's great for the momentum for the company. So that user-based growth, particularly on the free side, is a reason to be very bullish on the long-term revenue growth for Spotify. Speaking of revenue growth, there are two line items here for revenue: premium subscribers and ad-supported subscribers. There are reasons to be excited about both of those things. CEO Daniel Ek has talked about, on the premium side, there's an opportunity to increase prices. Now, that's negotiations that they have to have with their content partners, so specifically the record labels. But even the record labels have talked about increasing prices and, as a result, revenue and margins as a result of negotiations with Spotify. So it seems like there's momentum on the side of increasing prices, which would likely increase gross margin on an absolute basis, maybe not necessarily on a percentage basis, but on an absolute basis, increase gross margin for Spotify. And so that could really help the bottom line. The other thing to look at is ad-supported monthly active users and ad-supported revenue. Now, ad-supported revenue has kind of been all over the map, partially because this is a brand-based advertising platform. There's not a ton of direct advertising, at least quite yet. So that's why you see the fourth quarter is going to be much stronger than the first quarter. That's why revenue is down 27% quarter over quarter, but year over year up 17%. Not growing as quickly as the number of users, so you'd like to see more growth there. But I think the recent changes that Spotify has made to its ad platform, to the way that it thinks about its business even, are both going to be really positive for the growth in the ad side of the business. So there's really two opportunities to grow revenue. One is the premium side. That's probably coming in the next few months. And the other is on the ad side. When you add all of these things together, containing operating costs, a growing funnel of users, and increased revenue from both premium and ad-supported products, I think there's a lot to like about Spotify's future. The tailwinds are behind this company, it's taking market share, and I think the financials are just starting to improve. We will see exactly what happens over the next few quarters, but we should start to see an impact on margins starting in maybe the second quarter, probably the third or fourth quarter of 2023. So, what do you think about this stock and its operating momentum? Love to hear your comments in the comment section below. Don't forget to follow Asymmetric Investing and check out that deep dive I did in the link below. Thanks for watching, everybody. See you here next time.